With supply chains becoming more complex, you need to stay on top of the latest logistics developments. So if you work with logistics, you need the Beyond the Box podcast from Maersk. It's the easy way to keep up to date with everything from digital disruption in logistics to the need for supply chain resilience in today's market. Find out more and keep ahead of the game with the Beyond the Box podcast on logistics insights at maersk.com/insights.
Welcome to the Invest Like a Boss podcast.
I'm Sam Marks.
I'm Derek Sparts.
And I'm Johnny FD. We're self-made entrepreneurs who invest our own money and use modern technology to invest like a boss.
Join us each week for exclusive interviews with our network of modern investors, business owners, and multimillionaires to discover new ways to invest our hard-earned cash.
Hey bosses, episode 298. I just landed last night back in Barcelona for a month. Going to catch the last bit of spring, and it is in the air. Beautiful, Derek. I think I'm finally matching your weather in Southern California again.
Yeah, it's perfect here. We had a really rainy winter, but it's been like gorgeous lately. I actually saw your post on Instagram last night, I think, and I was like, wow, that actually looks great too. So we're in the two best weather places in the world, I think.
Yeah, I totally agree. I mean, whenever you get off like a plane in a nice place, it always feels like you're in like this romance period for a few days. But I swear, every time I come to Barcelona, I'm like this. I will go on the record saying, like, if you work from home and you have a budget of $6 to $10 grand a month, it's the best place in the world to live. I mean, for everything it offers, and like, you get yourself this dual membership at like Soho House and Sir Victor. You hang out at the pool and workspace all day. Restaurants, you have Glovo delivering anything you could possibly need on a bicycle to your doorstep in minutes. Perfect weather. All the great things of California without...
I was just going to say, you talk so much trash about California, and you literally just explain like every tech bro's life in LA.
I know, but look, it's 3 times the price.
I don't know about that. Barcelona isn't cheap.
The Spanish used to call California New España.
New Spain? Okay, I can see that.
But actually, Spain's a third the price, exact same weather, without the homeless people. Instead, we trade all the homeless people for pickpocketers. So you take the pick.
You take the good with the bad. I thought Barcelona was beautiful. Maybe it's just because I don't speak Spanish or the few words I know. But I found the people in Barcelona to be kind of rude, actually.
They are. That's the bother. I will say that's the rub with this place. But if you're more of like an introvert like me, you don't mind it because it comes with its positives. Like everywhere you go, people keep to themselves. You go to the gym, no one's talking, like, grunting, making a lot of noise. People they don't have their phones out. They're not. Yeah, it's like conservative in that way, which I've always found like it's nice. I don't really need to talk to my neighbors, And if the shop owner doesn't really help me that much, it's fine. I'll just order on Amazon.
The gyms here look like you walked into an OnlyFans video shoot. It's ridiculous. I'm just like, I'm going to go back home and do a YouTube workout video. I'm good. Yeah, good call. Speaking of, I love the new home podcasting setup. It's like OG Derek back in the hood. Classic. Yeah, if you haven't heard the last couple episodes, I actually closed up shop on the Malibu podcast studio. I miss it, but I don't miss paying for it. So back home.
Yeah, just cycling in and out, just like the markets.
Exactly, which is what we're going to talk about today. This is like a back to basics episode. Sam had suggested this, and I was like, you know what? That's a good call because sometimes I know Sam and I both do. Johnny's a little more disciplined with his investing lately, but we get off the rails and we get excited about random alternative investments, which are fun. But sometimes it's nice just to be on track, doing the steady move, which is essentially the S&P 500.
Yeah, so we'll call this episode S&P 500 a complete review. It's kind of back to where we started. This episode easily should have been in the top 10 first 10 episodes that we record. But, we need to go back and look at this because we talk about the S&P 500 all the time, but do we actually know what's in it? I think most of us have an idea. I think a lot of us, probably a majority of us, may have an investment in the S&P 500. But, thinking about global markets, I really wanted to look into detail, like how much international exposure does the S&P 500 have? How much has it changed over the course of time? And some of the historical trends that are building up to today. I think we've all seen so many shakeups in different asset classes, especially in small businesses and alternative assets, that over the last 12 months, at least from my standpoint, I just want to return to the staples. I don't want to take more losses. I want to get back into staple investments that are tried and true and have good historical track records. All fingers point to the S&P 500.
Let me ask you this before we jump into everything here, Sam. What do you say to someone who goes, why would I invest in the S&P 500 right now when it's at an all-time high? As we're recording this, the S&P 500 is at an all-time high.
Oh, man. Just hearing you say that brings back so many key points through like the 280 episodes that we have. And like, as you said it, little sound bites are popping up in my head. I know the one with Betterment was talking specifically about how the stock market spends majority of its time at or very near all-time highs. So yeah, it's something that's always on your mind, right? When it's at the all-time highs, it's like, it's scary. You want to wait for it to pull back. But historically, you will be better off putting money in at an all-time high than waiting for it to pull back. And remember, when it pulls back, it's not easy to invest because usually it means an event's happened. The war is expanded. Some big companies have some major layoffs. It always is a scary time to invest when it's falling. And it always seems like an easy time to pull the trigger when it's growing. So, when people ask me about investment advice or the S&P 500, it's pretty simple. Don't take my word for it. Just listen to Warren Buffett. So he redoes his will every 3 years, but investment advice or the investment strategy left to the trustee is always the same. It's to invest 90% in the S&P 500 and put 10% in U.S. Treasuries or cash equivalents. So, there's the greatest money man of all time. That's his advice. It's always been the same ever since I've been following him. And then, two other anecdotal pieces of advice. J.L. Collins' book, one of the greatest investment books I think, a lot of our listeners have read. The Simple Path to Wealth. Pretty much that whole book comes down to the same advice of Warren Buffett. And just another quote from managing partner at Landmark Wealth Management. When you buy the S&P 500, 90% of the time, you're likely to outperform an active portfolio manager picking large cap stocks. So the S&P 500, which is technically a large cap stock index, will just do better than 90% of investment managers that are picking large cap stocks that would seem to have some type of information edge, but they don't. It's a very sound investment. And, I think Warren Buffett's advice wraps it all up.
The problem that I think we found with that is we all let our egos get in the way. We think we found the next amazing stock, the next better fund manager, things like that. But history shows for well over 100 years now that chances are you're not going to do any better than the S&P 500.
Yeah, it's amazing. I revealed my E-Trade account, which I've been running since we started this podcast, 8 years, in parallel with my Vanguard account, which is just my index portfolio, against my Wealthfront account, which is a robo-advisory automated index portfolio. And then my E-Trade account is just my stock picking portfolio. Now, both my Vanguard and E-Trade account have doubled in the 8 years that I've had them. And my E-Trade account is up an astonishing 3% over the same period. So that means, ladies and gentlemen, I've lost a lot of money because I'm also paying income tax on the income portion of that.
Inflation.
Over 8 years. Inflation and the opportunity cost of not being in the S&P 500 index fund. So that was more a personal experiment. It is fun to try to beat the market, but generally it's horrible advice to try yourself or even with an investment advisor.
I completely agree. And I think we're slowly learning that lesson. Well, I don't think we'll ever fully learn that lesson, but we have to have some money that we can play with.
Yeah. Here's another piece of the quote from Warren Buffett I just found. So regarding his strategy for what it looks like it will be, he's giving his wife when he passes away. And, Warren's getting up there. I
think he's 93 now. They just did the Berkshire Hathaway annual meeting like 2 weeks ago.
Wow.
I actually watched a big chunk of it on YouTube. He is a little slower. This is actually the first one without his business partner, Charlie Munger, who passed away last year. But he's still all there. And he's still talking about things that he's excited about to invest in and stuff. He did get asked about AI, which I thought was interesting. And he was like, I don't know anything about that, and I probably don't have to worry about it. So he is conscious that he's gonna die soon, but he's still very into like fundamental real businesses.
Yeah, it just goes to show how important it is, longevity with just keeping the mind sharp, because man, he's 93, sits in a chair most of the day and eats McDonald's every single morning. So
he must have crushed 7 Diet Cokes while I watched that video.
Hey, and a little sugar doesn't hurt either, apparently. So here's the second part of his quote. I believe the trust's long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutional investors, individuals who employ high fee managers. He's basically saying you can't beat the S&P 500 in a passive or semi-active way.
And going back to like the fundamentals of iLab, we're going to touch on it later too when we talk about how to invest in the S&P, but just management fees in general, you need to really be conscious of what you're actually paying these funds. I know some of the biggest offenders I've seen is I know that people that have like a regular 9-to-5 job and they invest in their retirement accounts with their companies. First of all, these companies are usually getting paid to do these funds. And if you look at the funds that a lot of these retirement accounts that you're usually forced to get into, the fees are crazy high.
Oh man, it stings so bad thinking about some of this stuff in my past. Like when I started really looking at my investments through one of my financial advisors, and I remember they had told me, oh, hey, we want to move your money out of like, it probably was like an S&P 500 index fund, my Roth retirement, right? Mm-hmm. And when I turned over my finances to them, they're like, hey, we want to move this into this Janus fund. We think we can outperform your current investment. And I'm like, yeah, sure, guys. Like I trust you fully, go for it. And that was the last straw. Like when I decided, hey, I'm not doing this anymore. I'm going to figure out how to manage my own investments. Because I looked up that fund after they went ahead and did it. It had a 5% load fee, which means when they put you in that fund, they take 5% right off the top. And then it had like a 1.6%. So dude, I was like sick to my stomach when I saw that. I'm like, how can you shave 5% off someone's Roth IRA? That's like thievery, right? And then 1.6. So they're making a commission off all of that, right?
Oh yeah, that's the reason they're pushing you to those particular funds. Yeah.
Unreal. But hey, I'm glad they did it because it forced us to do this.
Yeah, so I think the whole point of iLab and stuff is like you can take control of this stuff for yourself, or at least be more aware of what you're getting involved in with a financial advisor. If you have to use one, or if you just feel like you can't handle it, there are definitely things to look out for to save you a lot in fees. We'll touch on more funds that you can invest in to directly the S&P 500 near the end, but why don't we talk about what the S&P 500 even is, Sam?
Yeah, we'll go for it, Derek. Enlighten us all.
So I did a little history, first of all. The S&P 500 was like officially created in 1957. It became 500 stocks, but it existed in some form before that. S&P, first of all, stands for Standard & Poor's. Now, do you know why it's called Standard & Poor's, Sam?
No idea.
I feel like I wanted a more exciting answer because I was like, oh, it's Poor's in there. There's got to be some kind of reason why they call that. It's dealing with money and things like that. It's really just simple. There was a company called Standard Statistics and Poor's Publishing, and they just merged in 1941. So not a very exciting story. But there were two companies that they were just like, you know what, we need like a standardized index to put out a number for investing. And this is obviously well before the internet or before like most retail investors. So this is more for the Wall Street people, and they needed a benchmark on how to trade. And I still to this day can't figure out how the S&P 500 number is calculated. Mm-hmm. It's a proprietary formula that they take, the 500 largest U.S. public companies by market cap. So it's basically their total value of all their outstanding shares, and it represents over 80% of the U.S. stock market. So a lot of people will be like, oh, what did the Dow do today? What did NASDAQ do today? Well, those are just tiny pieces of the U.S. economy, especially the Dow Jones Industrial Average. A lot of people don't realize that's only 30 stocks. And it's not even the 30 biggest stocks in the US. It's like handpicked by a certain group of people there are obviously all large companies, but it's not necessarily the 30 biggest companies in the United States. So it gives you just a tiny picture. If you think about the average American probably uses over 30 companies just in a day. So it's just a tiny fraction of anything. Whereas the S&P 500 is 500 of the biggest companies. It's almost $40 trillion. That was as of this article written, and now we're at all-time highs. It's probably even more than that.
Wow.
But as companies rise and fall, they enter and leave the S&P 500. So currently we have like a lot of the top companies are dominated by tech, which is fairly obvious. You know, tech margins are insane because they don't have, you know, actual physical products most of the time to really weigh down their margins. And why don't we get into like the top 10 companies in the S&P, like literally the top 10 by market cap, Sam? Why don't you give me like, what do you think 3 names that are in the top 10?
I cheated. I looked this up. I can't fake it. Come on. I can't fake it. But you want me to name a few? I will say this. I shouldn't have been shocked, but I was.
Okay, give me one you were shocked about.
Well, the one that surprised me actually was that Alphabet had 2 in the top 10. And I kind of forgot, Alphabet being, you know, Google. I forgot that they have 2 different classes of stock, and both of them were in the top 10. I had to look it up because I'm like, wait, Alphabet's listed here twice. Must be some mistake. But it's just their Class A and their Class C shares.
Yeah, I think they did that a few years ago, like 2 or 3 years ago. And it's so wild to think that Google/Alphabet is that big that they can split their stock into 2, and it's still the top 10 companies in the United States.
Yeah. And I had actually looked this up. Like, I think I looked it up like a year ago. I'm like, I wonder what Google's trading at. And I looked it up, and it was like under $1 trillion. But then at the same time, there's like, you know, Meta, and even Tesla was closing in on $1 trillion, and all these other companies that surpassed $1 trillion. I'm like, wow, that makes Google sounds cheap. You know, they're like, you know, their price, you know, way less than all these other companies. And it turned out that was only half the company.
So I think even combined, I still don't think they're the biggest company in the world. Oh, I mean, the United States, but essentially the world is what we're talking about here as well. A lot of people don't realize, I think if you ask most people, they would probably say Apple. Apple would be the biggest company in the US. It's actually not. Microsoft, of all companies, you kind of forget that it's like the majority of computers are PC, Windows based. Microsoft also owns a ton of other businesses. They're deep into like AI and all that stuff. They literally have like hundreds of companies under the Microsoft umbrella. LinkedIn, like just random stuff like that.
Yeah.
And you don't think about that because like Apple has such like a crazy cult following, like a Tesla or something like that. Sam, before we even got on here, you said you just bought a new laptop, and I'm assuming it's an Apple.
It's an Apple. And my gosh, man, it's cheaper than an iPhone. I just got the new. I got a Mac,
I'm aware of the iPhone prices.
Bro, it cost me. I want to say it cost me under $900.
My phone was $1,500.
Yeah, I bought it in Thailand because the exchange rate's so good right now. It was like 29,000 baht, which it might be $850. And I got a 5% tax refund.
Oh, amazing. maybe that's the hack.
Amazing.
How much can I pay for shipping from Thailand?
Get a free flight. No, you don't get a free flight. Take that back. $800. No. What surprised me looking at the S&P 500, because I guess I've always thought the S&P 500 is 500 biggest companies in the US. But I think of big, more like consumer names like McDonald's and things like this. But just to see how much of the top 10 is dominated by technology, 8 of the top 10 are technology companies. One of the companies that's not technology, I've never even heard of them before. And I don't know what industry they were until I looked it up. Do you know what company that is?
What, Eli Lilly or Broadcom, maybe?
Yeah. No, Broadcom's technology, but
Eli Lilly is a pharmaceutical company, so I definitely am very well at that. I mean, maybe that's because here in the U.S., especially with COVID happening the last few years, we've heard about all these pharmaceutical companies just raking in cash, and seeing one in the top 10 in the world is no surprise after that. Yeah.
And the other company that's up there, well, we were just talking about Mr. Warren Buffett. So there's Berkshire Hathaway. I think it's about the 7th or 8th biggest.
And they have a couple classes of shares too. I wonder if that's weighted as both classes of shares, because I believe there's 2 classes of shares in that too. But I mean, obviously Berkshire Hathaway is a beast. They just acquire, value companies and invest super wisely. And there's a reason that each share is what now, like $500,000, something like that.
Yeah. So just to round out the top 10, guys, it's Microsoft, Apple, NVIDIA, Amazon, Alphabet Class A, Meta, Alphabet Class C, Berkshire Hathaway, Eli Lilly, and Broadcom. The weights of these at the top are pretty heavy, pretty significant. So Microsoft is almost 7% of the index, Apple 6%, and NVIDIA 5%. So guys, if you invest $100,000 in the S&P 500, you have a $7,000 investment in Microsoft, a $6,000 investment in Apple, and $5,000 investment in NVIDIA. So it's something to remember when you're investing in S&P 500. You don't necessarily need to go pick up more stock. I mean, you can if you want to tilt your portfolio towards that individual stock, but just know that you already have a shareholding directly in that company.
Yeah, and I think that's a lot of things that we don't think about. We're like, oh, I got to get in on Microsoft, or I got to get in on Apple. There's a new iPhone coming. But if you own the S&P 500, you actually still own a small piece of all these companies.
Yeah. And something Derek touched on earlier was how the index changes over time. So what this is called in finance terms is turnover. So the index has a certain turnover, and every index will be different. So you can imagine as some companies will fall out of the S&P 500 and some companies will gain. Like the last big company that I remember going into the S&P 500 was Tesla. So I looked it up. There's the annual turnover of the S&P 500 is 4%, which is quite low in terms of indexes. It's about 22 changes. Last year, there's 22 changes into the S&P 500. Now, why that's important is because when you own an index fund, it's like a stock. So if you buy it and you sell it, you realize a gain or a loss on that. And it's true for an index fund, but also in an index fund, if the index fund loses positions or gains positions or exchanges positions like these 22, that means the index has to sell that position and buy another one. So when they sell that position, if that company has had a gain in stock price, you will have to realize your pro rata portion of that gain. So every year in a stock index like the S&P 500, you'll notice on your tax returns that there will be a small amount of either long-term or short-term capital gains or losses you have to pay, and that's because of that turnover.
Well, and thankfully that these S&P funds specifically have a really low turnover rate. Even 22 out of 500 is less than 5% of the actual stocks. So that's good. Some of these, funds, these riskier like hedge funds and things like that, or individual like sectorized funds, like they're just turning over stocks daily. I feel like they're just justifying fees. They're like, look what I did today. I sold the stock.
Meanwhile, it's just an automatic trading algorithm that's doing it.
Exactly. ChatGPT is trading for you.
If we did good, it's because of us. If we did bad, we need to update our algorithms.
Exactly. Okay, Sam, since tech is 70% of the top 10 companies in the S&P 500, I feel like it can't be 70% of the entire S&P. So why don't we have you break out the sectors here? But first, we're going to take a quick break and we'll be right back.
At Evernorth Health Services, we believe costs shouldn't get in the way of life-changing care, and we're doing everything in our power to make it possible. Behavioral health solutions that also keep your projections at their best? It's possible. Pharmacy benefits that benefit your bottom line? It's possible. Complex specialty care that cares about your ROI? It's possible. Because we're already doing it. All while saving businesses billions. That's Wonder made possible. Learn more at evernorth.com/wonder.
Ryan Reynolds here from Mint Mobile. With the price of just about everything going up during inflation, we thought we'd bring our prices down. So to help us, we brought in a reverse auctioneer, which is apparently a thing.
Mint Mobile Unlimited Premium Wireless. How to get 30, 30, bit to get 30, bit to get 20, 20, 20, bit to get 20, 20, bit to get 15, 15, 15, 15, just $15 a month? Sold!
Give it a try at mintmobile.com/switch.
$45 up front for 3 months plus taxes and fees. Promo rate for new customers for limited time. Unlimited more than 40 gigabytes per month. Slows full terms at mintmobile.com.
Back here on the podcast, Sam has broken out the entire S&P 500 into sectors. Now, how is this all determined, Sam?
How's it determined? Well, it'd be determined by market cap of these companies. Just because the top 10 companies are mostly tech doesn't mean, like you said, it's going to be mostly technology. It's just those companies own such a massive piece of it. But overall, technology as part of the S&P 500 make up about 25%. So it is significantly weighted into the index. And imagine most of that 25% has come in the last 10 years, because before that, prevalence of technology companies, S&P 500 was a lot less. Under that, the next biggest sector is healthcare at 14%. I'm guessing that's Eli Lilly,
Pfizer, any health insurance company. That just shows you that how much we're getting ripped off in the United States, because the vast majority of all that money is coming from people in the United States, even though these are worldwide companies. Like, that's just how much we're paying in the US.
Yeah. And we've touched on pharmaceuticals quite a bit, actually, indirectly through our stem cells episode, and most recently with Matt Buckley talking about psychedelics. And Derek knows all too well.
Yeah. Health insurance bill every month is more than it's.
Dude, I pay health insurance every month. I spend 2 weeks a year in the US, and I still pay health insurance every month. $250 a month, man.
Yeah, that's crazy. I guess, I mean, and then otherwise, if you don't do it, you're getting penalized. So you're like, I might as well just pay for it anyways.
Yeah.
It's such a racket.
And it's not like it does anything for me. I have a $5,000 deductible. So even if, no matter what happens, I still pay out of pocket.
Yeah, I actually paid up for the good one because I know myself and injury prone, and I feel like I'm just aging times 10 lately. Yeah. So anyways, what's the next sector, Sam?
That's what's next. Let's talk about financials. 13% financials, so it'd be all your banking stocks. 10% consumer discretionary. So here's a question, Derek. Do you think Tesla falls in technology or consumer discretionary?
Well, if you talk to their almighty CEO, they are a technology company.
But if you ask the S&P 500, they're a consumer discretionary because they're not essential. They're not a consumer staple, but they are a consumer product now.
What would fall under consumer discretionary? Like actual physical products, I'm assuming. So, like Tesla, you buy a car. I guess you go to the store, you buy a whatever.
Yeah, it's a tricky one. Like Apple should technically be consumer discretionary, but they're certainly considered technology, right? So it probably depends on how much of their revenue streams is actually categorized as technology or consumer discretionary, and who makes up that rule, I don't know.
Sure, that makes sense. What's next?
Yeah, next one, 9% industrial. So this would be a company like 3M. Communication services at 8. So you got Broadcom in there. Then you got consumer staples at 7. Hello, McDonald's. I'm doing the big golden arches there for you, Derek.
Lots of controversy around McDonald's lately. It's I think they priced themselves out of the market, but we'll save that for another episode.
What, like $20 Happy Meals is priced themselves out?
Oh yeah. I could go get like a real restaurant meal and pay the same price as I would at McDonald's. I'm like, why would I eat this trash?
Because you can't beat a McMuffin in the morning.
Oh my God, sausage egg McMuffin. All right, you won me back over.
All right, rounding out the categories: 5% energy, 3% utilities. Oh, just the baby there. Comcast, loser. 3% materials, and this is interesting, right? 3% is real estate.
That is actually really interesting, especially when we've been hearing all the stories about all these giant corporate real estate companies kind of taking over the market and taking away from the individual consumer.
Yeah.
When in reality, they're still a very small piece of the market.
Yeah, I think it just probably also testament to the fact that a lot of real estate is privately held and not in public companies. Most of these public companies, these will be big hotel chains, and some of the large REITs, which I've gotten my ass kicked on recently. So one thing that I found really interesting looking at S&P 500, I spent a couple of weeks earlier this year really looking into the US deficit. And maybe it's just because I'm being retargeted with like headlines and clips, but it seems like it's always in the news and no one really knows how it's going to pan out. Or, occasionally you get a banking CEO like Jamie Dimon coming on and being like, hey, this is a ticking time bomb. We got to solve it, right? And I'm like, all right, what is actually going to happen here? So I researched it, and it made me start getting really concerned, as I have like at times in the past, about the US deficit and being overexposed to the USA. So I started researching it, and it's like, what are you going to do if you want to diversify outside of the US? And my conclusion was, you really got to go into alternative assets or into like crypto, basically. Because if you just want to invest outside the US in public equities, good luck as an exposure. Because if you go back and look at, say, 9/11, you look at an extreme event where like, all right, here's a black swan event where only the US gets hit. right? Like, okay, what happens if nuclear bomb drops on New York City? Well, look at what happened in 9/11. If you look at all the other major stock indexes in the world, they all got nailed and they all recovered over the same time. So like Japanese, the Nikkei 225, the HSI, the ASX 200, the FTSE 100, all of these sunk and more or less recovered at the same time. Actually, I think the US indexes recovered even quicker, which is crazy, right? So that just goes to show you, like, even in an extreme situation where the US is basically attacked at war, has some major event that really only hits them domestically, all the world markets are intertwined. So I spent some time last year like diversifying out of the US into index funds in Australia and Japan and Hong Kong. And then I'm like, I got to a point, I'm like, it's not going to matter if the US, something happens that pulls the S&P 500 down. I can't think of a scenario where it doesn't pull these other markets down. So if you want to simplify, keep things simple, diversifying across all these different countries doesn't make a ton of sense. But some of the lessons that we learn on this podcast are, historically, what you want to do is not have home country biased. You want to be 50% in the US market, and you want to be 50% international. And it doesn't matter if you're American or Australian or Singaporean, like you should have 50% international, total international, and 50% in the US market. So just to touch on the international exposure again, so 70% of S&P 500 is income sourced in the US, while 30% is abroad. So if you're worried about the US dollar or USA exposure, US market economy, you have a 30% hedge built in to the S&P index.
That's what I wanted to ask you. So let's say I had my entire net worth in the S&P 500, which we wouldn't do, but just for the purposes here. Am I just assuming that I'm already 30% internationally exposed, so I should just purchase 20% then of the rest of my net worth in direct international investment? Does that get me to the 50?
It depends how scientific you want to be about it. I mean, there is some comfort in directly investing in international companies. The S&P 500 for us as Americans will actually be the most tax efficient, because when we invest in, if you look at your tax returns, when you invest in these foreign indexes, they get taxed much less favorably as if you invest in a US index. And if you look at these foreign indexes compared to the S&P 500 over the last 20 years,
they're usually not as good.
You get a graph where one stock index is the bottom flat line. It's like, what's the y-axis or the x-axis or whatever? Like, seriously, look at any of these other indexes compared to the S&P 500 over the last like 25 years. One of them just becomes the tabletop, and the S&P 500 just rocket ships up.
Yeah, what is it? The Japanese Nikkei? I think it's been flat for 35 years now.
Yeah. I mean, yeah, as they always say, historical returns do not guarantee future results. So
we got a pretty good basis here, though. I'm not saying it's going to keep going up and up and up, but we have well over 100 years of data in the US, and things look pretty good if you're in there.
Yeah, they do. We'll touch more on that in the outro. A couple more points on international exposure. So right now, the US dollar is really strong. So, some people think the US dollar is going to collapse. Okay, so then it does make sense to hedge into international companies. But if you look at the US, the S&P 500, so 30% of these revenues are abroad. So that gives you a US dollar hedge as well, because those earnings are in different currencies. Now, what will happen now is actually it cuts both ways, because the US dollar is so strong that the earnings from those international countries is discounted, right? Because it's converted to US dollars, it's actually weaker earnings. So if the US dollar weakens significantly, then those will be appreciated in gains, basically. Does it make sense?
Yeah, that's a good call. It's something that I think a lot of people don't think about as well.
Yeah. So the countries that make up the biggest contribution to revenues outside the US.
Wait, can
China,
I guess?
Japan.
Can I guess? All right, fine.
You weren't going to say China.
Let me guess. Is there some European ones on there? What are we saying? Top 5 here?
I don't know. Go ahead.
Okay.
Go ahead. Give me 6.
Okay, China, Japan, you said. I'm going to say the UK. Is that yes? No?
I'm not saying. You give me 3 more.
I gotta guess 3 more after that?
Yeah.
Okay, Canada?
Are you just being nice to our neighbors up north,
maybe,
or you really think Canada?
How about the UAE, where like Dubai and all that? I don't know.
That's interesting guess.
I feel like I'm way off here.
How about the biggest countries in Europe, Derek?
I mean, Spain, France, Germany, maybe.
Germany, France. You got them all. UK, Japan, Canada, Germany, France.
I'm actually kind of surprised by France. Maybe just when I go there, they're always on strike or not working.
Wine and cheese, man. They don't have to do much else.
Sorry, run through that list again. I was goofing off there. Give us the 6 again, Sam.
China, Japan, UK, Canada, Germany, France.
Oh, see, Canada was there.
Yeah, Canada's up there. Canada's number 4 on the list.
Trying to doubt me out here. Okay.
Now what's interesting is just this is a very interesting data point. So 70% of the U.S. Of the S&P 500 revenues come from the U.S., 30% abroad. But if you zoom in only on the tech sector, how much of those revenues of the technology sector do you think come from abroad versus the U.S.?
Ooh, I mean, it's got to be huge. So the percent, we're talking the percent of international revenue from just the tech sector. I'm going to say 50, probably 50%.
Okay, think about this. What do you think about like Facebook? What do you think of their revenue split would be?
Oh, they have over 1 billion users, and I guess there's only 300 million people in the US. So right there,
that was pretty smart, quick calculation.
We're at 70%. Wow. Okay, 70% then I'm going to go if we're basing it on Facebook's model.
Yeah, I mean, pretty much. So it basically flips. It's 65% international for the technology companies.
That's huge. So, and I feel like there's so much more development that can come because we're obsessed with our phones in the US, and you go to pretty much any other country, they have them, but they're not glued to them like we are. And if these tech companies can convert people to do with their phones what we do here in the US, it's trillions and trillions of dollars.
For sure. All right, Derek, how about some information on like the historical returns and performance of the S&P? You said it was started in 1957, right?
The official like S&P, like the 500 stocks, but obviously the composite's been around since I think 1928 is as far as I could go back. So 96 years. In those 96 years, Sam, how many of those years have been down years out of 96? What do you think?
96 down years. 96 down years. Okay, I would say 2 to 3 out of 10 would be down years.
Okay.
So 90 years, let's say 20, give me 20 years.
Oh, I thought you were onto it. You got to go a little bit higher. There's been 28 down years in the last 96. So you're definitely on the right track.
All right. Well,
now, obviously, if we think of some of the times here, I mean, the huge stock market crash in 1929. I love how the first calculation was in 1928, and then it just crashes the next year. I feel like they had to be like, wait, did we cause this?
Dude, that's like my investments. It's like, all right, put the money in. All right, cool. Everything's cool. Crash.
So just skimming this list really quick. I mean, that accounts for 1, 2, 3, 4, 5, 6, 7, 8, 9. So 9 of the first 14 years were down. I mean, we're talking 1928 until World War II. So that's a third of them right there alone. And then actually, surprisingly, the year after World War II, 1946, was also down. But I think the whole world was kind of like, what do we do next? So they needed a good year off to kind of celebrate the end of the war. And then we got back to work. The 50s all looked pretty good. There was 2 down years in the 50s. The 60s, there was 2 down years, or 3. So yeah, you're about right. There's 2 to 3 every decade. And then pretty smooth sailing until we hit the dot-com bubble, early 2000s, and obviously 2008, 2009. So if you look at this chart, we did have a down year in 2022, but 2018 as well. I was going to say, I think we're due, but if you look at the actual numbers, we're steady Eddie to a decade.
Steady, we're right on it, huh?
Yeah.
Man, we should pull up these charts next time the market's tanking, just as like historical reference. I mean, I know we always have in the back of our mind, but if you actually look at the data, I think it supports, making moves much better. And one thing
it supports not making moves, Sam. Just leave it alone.
Or not making moves. No, but one interesting thing that I found was the S&P 500 has dropped more than 19.5. Let's call it 20%. More than 20% 4 times historically. But what's amazing is each year that it dropped more than 20%, the next year it made up that loss.
Yeah, so let's take one that probably most of us are aware of. So how much do you think the market dropped in 2008, Sam? The S&P, we'll say.
It was like 40%, 35%?
38.5%. The very next year, so let's say you threw everything in that and you're like, okay, I'm going to go off historical records and this is the time to invest. In 2009, what percentage would you have made?
30. more or less 35%.
It's actually less, it's 23%. But then if you give it one more year,
23.
in 2010, you have 13%. So you're back to even in 2 years, which in time, I mean, 2 years goes by quick, honestly, when you think about it.
2 years goes by quick. Yeah. So historically, if we ever see the market drop 20% or more, we should just pile in, because over the course of the following 5 years, you pretty much double your money. This thing is each time the market drops more 20%, we think the world's coming to an end. And it's different than the last times before. And it's scary as hell to pull the trigger, right? Because you look at your net wealth, you have less money, and you're like, well, now is not the time to be gambling like what I have left. That's how it always is, right? But historically, that's the move to make.
Let's take an even more recent example, because 2008 was catastrophic. You know, that's not going to happen very often. I'm not going to say it won't ever happen again, because it definitely will, but hopefully not for a long time. 2022, just 2 years ago, the S&P 500 was down 19%. Had you jumped in then, in 2023, you would have made 24%. So you got all your money back plus 5%. Meanwhile, your next door neighbor sold everything, panic selling, and lost the 20% plus the 24% opportunity gain. So they're probably down like 45%.
Jeez. How about the historical returns, Derek? What's the average that you were able to find?
So it depends on how far back you want to go, Sam. If you go back all the way 150 years since it basically started, and this is, you know, paper trading on the floor and everything. I think technology has advanced us, and so many more people are in the market now that retail trading is a possibility. But if you go back all 150 years, 9.2% is the average return of the S&P 500. And if you just want to go back as far as 1992, this is up from 1992 to last month, April of 2024. It's actually 10.8%. So I think all this extra money going into the market and your average retail investor has just grown it that much more and makes our economy that much stronger, that I think we're going to continue to see increasing returns as more money floods into the market.
Yeah, and that number matches all the way back to 1957. There's also since 1957, which is when the index adopted all 500 stocks. Yeah, 10.26%. So, I mean, that's a great number. And whenever I hear 10% returns, I always think your money doubles every 7 years at 10%. 7 years goes by in a blink, you know? Yeah. So that would be, what were we at, 2024? If my money doubled by 2031, dude, I'd be super happy.
Yeah, I totally agree. And that's a lot of things we don't think about is we're not like full-time investors. We have other ambitions and goals, but if we know that our money is invested properly and it's going to double every 7 years, I think that's a huge peace of mind.
Huge. So one thing to really think about, especially in today's world, is inflation. So what affects that 10% annualized return? Inflation and taxes. And what we have best to look back on was a high inflationary period that covered the 1970s. It was like 13 or 14 years. And during those 13-year periods, the average return of the index was only 7%. So it was worse returns. Stock markets typically don't do too well in inflationary periods, but it was still up 7% on average. The problem was during that 13-year period, average inflation was 7.9%. Ooh. So you have a loss there. You have about a 1% loss each year, plus you're paying tax on the gains. That sucks. And that's also known as stagflation.
And those 1970s tax rates were insane. Like I think the top tax brackets were like 60 or 70%, something like that. So
yeah. And I think that's what the Fed is kind of desperately trying to avoid right now, because that is not fun at all. And you can imagine having your money tied up in the market for even really 1 or 2 years. Like even after 1 or 2 years recently of high inflation, people are like, oh, I don't know, like, you know, scrambling to figure out what to do. It's not comfortable. So you can imagine after 10 years, like who would have the teeth to keep the money in the market then? You would want to pull it out and just be like, screw it, I'm just going to go spend it. Like, what's
exactly.
the point? I might die. I can't take another 5 years of this, man. I'm dying over here. I'm getting old.
I think this is a good reminder that we kind of get to fear mongering that everything's really terrible. But if you look at previous decades and times in the economy, I think we're in a really good space still. Because if you compare this to the 70s, like you just said, we're way above that. Like we're nowhere near that. And hopefully we'll never get back to that again. But things are pretty good, Sam.
Yeah, I guess. I mean,
I sense some hesitation there.
Yeah, no, it's very easy to zoom in on the negative stuff. It really is. And Paul Merriman, who is one of our, in my opinion, is one of the best episodes, best interviews that we've had on Invest Like a Boss. I think he's probably in his mid 70s when we interviewed him. Incredible money manager, seen it all. And he was like, look, it's never looked good. He's like, since I've been a kid, it's never looked good. World was always on tilt. It always looked like things were going to end. It looked like capitalism was going to end. It looked like war was, massive war was always imminent. And if you look at things now, certainly feels exactly the same as that sentiment, right? But things keep ticking along. And I think the long arc of the world is evolution, and that things evolve and become smarter and more efficient and work better together. But there's always these ups and downs. So I agree. Look, there's a lot of scary things out there in the world, but what's moved the market higher historically and created these 10% returns for over 100 years? Three main things, three pillars. One, population grows. Two, capitalism is the dominant market force in the world. And three, that labor becomes increasingly efficient, i.e. tractor, technology, self-driving cars, et cetera, giving people, think how much more efficient the world has become with like smartphones, because now there is no 9 to 5, like people are working instantly all the time. Right. And even self-driving cars, that'll be one of the major benefits, is people now have an extra hour or two literally to be productive and buy stuff. So the amount of room that technology has to grow, like even what we can see is enormous, but think about how much technology we can't even see. We don't even know what's going to be invented in the next 5 or 10 years. And we see like a company such as Facebook, how quickly they go from a domestic company at a handful of small colleges in the USA to becoming a global beast with 70% of revenues internationally. So technology companies can grow quick and can globalize very, very fast. We have AI that's going to supercharge earnings of small companies and large companies alike. Robotics. I mean, there's so much in the pipeline that will become commonplace in 5 or 10 years. And technology specifically, I think, is going to be the leader.
There's so much exciting stuff in the pipeline. There's a lot to be positive about, and it's so easy to jump to the negative, like you said. I think fueled by these tech companies too, because they know that we love negative. Anytime I post anything like negative or something, I just know it's going to like crush online. And sadly, that's what happens every time. And they know us. I mean, I don't know. There's a lot of good things to be excited about in the world as well.
For sure.
Hey, bosses, we're going to take a quick break to hear from our sponsors. The show will be right back.
So I want to touch on dividends quick, and then let's summarize and make some conclusions on the S&P 500 and talk about what we're going to do quick. But I wanted to share some insights on dividends, because we have to remember the S&P 500 are large companies. In many cases, they're paying dividends. The record high of the S&P 500 in terms of distribution rate was 6.6. Boy, that would be nice.
I would love.
And the record low was 1.8, which
1.08,
like,
so barely 1%, actually.
Yeah, 1.08. That's like Bank of America's interest rate.
Exactly.
And the average was 2.9, or the median range was 2.9. Typical value right now is like 1.5 to 2%. So, you're getting kind of like 1.8% on average. Now, it's come down recently in years. Do you know why that might be, Derek? What might be a driving factor of that?
I would assume because these tech companies are jumping in, and very few of these tech companies even pay a dividend.
Oh, you're so smart, man.
Look
God.
at that. I didn't even cheat on that one.
I was looking at a chart of distributions. I'm like, something's wrong. Maybe the S&P 500 is overvalued. Dividend rates going down, blah, blah, blah. I'm like, it's overpriced, And then, of course, a little bit more research was like, no, stupid. It's because technology companies don't pay dividends mostly. And look at the top 10 companies.
We're starting to see them creep in. I did very well on Meta, and I'm holding all my profits on that. So it's basically a free ride stock. Nice. And then they announced a dividend a few months ago. And I was like, oh, yes, free money. Well, the dividend is 4% a year. But still, free money.
Happy days. Doing better. You're doing better selling call options there, Derek.
Yeah, we'll get into that in a future episode too. And so, yeah, these dividends are kind of pathetic from the tech companies that actually have announced one. What do you think Apple's current annual dividend rate is?
1.5%.
So Facebook was 0.4. Apple's like, we're going to one up you. We'll do 0.5.
Oh, healthy.
So yeah, that's why we're seeing the S&P 500 dividend just drop.
Yeah, just keep it, man. Apple, just keep it. It's cool if you'd have a huge cash balance and pay me out 0.5%. Yeah. Yeah.
Give me a credit towards my next MacBook?
Just keep your computer slightly cheaper for investors or something,
Yeah, exactly. That's kind of maybe one of the reasons that I was a little hesitant to go too deep into these index funds, because the dividends are pretty pathetic. I love me some dividend stocks. I like utilities, energy companies, things like that. But if you want to be properly diversified, you kind of got to just kick the dividend to the side and say, hey, it's a nice little bonus at the end, but it's really not going to be much. Probably won't even cover inflation.
Yeah. So here's some of the kind of conclusions of the benefits of the S&P 500. I know a lot of listeners are familiar with it. I think hopefully through this episode, you have a little bit more understanding of what's under the hood and what you're investing in. Maybe some more confidence based on the historical track record and trends of the S&P 500 and the companies within it. But just to touch on a couple of the highlights. So diversification, you have 500 of the biggest, most dominant US companies, and they are with international exposure. You get a 30% international exposure hedge, and that's also a currency hedge as well in one single investment. And I think before we go, Derek, we can highlight a couple of the best index funds or ways to buy the S&P 500.
Sure.
You also have a historical track record now going back 100 years. As Derek and I touched on, I think there's a fairly positive outlook. It's easy to zoom in on the negative stuff, but you look at what's ahead. Do we think the next 10 years will have faster growing technology, more globalization than the previous 10, more people investing in the stock market? I think that's clearly yes. Of course, there can be some challenging events ahead, but generally speaking, would definitely say yes. Then you also have this is a low cost, low fee option. So virtually no minimum investment. You can invest in the S&P 500 with basically probably $100, right?
I mean, $1 if you have a Robinhood that can buy pieces of shares. It's anyone can invest in this.
Yeah. And you have no commissions to buy it. You don't need a broker. And the fee is so minimum. I think it's like 0.03% or 0.05%. It's something you don't need to worry about it even over the course of the long term.
Yeah. So there's a bunch of fund options out there. I just pulled 5 out. Some we've mentioned on the show before and some you might not be aware of, but they're all essentially the same. They're designed to emulate the S&P 500 index. So if you look at their top holdings, it almost matches the actual S&P, like those top 10 companies we talked about. Just compare that to the top 10 holdings of these index funds. So I just pulled up one right now. Here's the top 10: Microsoft, Apple, Nvidia, Amazon, Alphabet, Meta, Alphabet again, Berkshire Hathaway, Eli Lilly, Broadcom. Exactly the same. And that's what these funds are meant to do. They're meant to emulate the S&P 500. So from there, it's basically on what company do you want to manage it. I mean, we've talked about Vanguard a ton. One that, we've talked a lot about and I own shares in, I bet you do too, Sam. I know Johnny does, is VTI. So VTI is Vanguard's total index fund. And this is actually, I wanted to talk about this one, even though it's not specifically S&P 500. It's actually what its name says it is, the total stock market index. So this is emulating the entire US stock market, even like micro caps. It's a small piece of it. It's very close to the S&P 500, but it's not exact. So if you want an even broader approach to get in some of the micro cap stocks as well, VTI is one that we've talked about a ton of times. Low expense ratio, 0.02%. But if you love Vanguard and you want to be in just the S&P 500, the fund that emulates that, they do have another fund called VOO. I'll put all these stock tickers in the notes as well too. It's just the S&P 500 ETF from Vanguard. Same thing, emulates the S&P 500. Expense ratio is 0.03%. And from there, you can just pick a company that you like. I'm going to list 5 in the show notes. Just go with whoever you want, and they all have low fees under 0.1%. A popular one that I see a lot and they advertise a lot, and that might be why their expense ratio is a little bit higher, because I feel like they have a marketing budget, is SPY, SPY. That's just the S&P 500 ETF trust, and their expense ratio is 0.09%, which is still low, but when you're like, I could get it for 0.03, you're talking 3 times the expense ratio. So it starts to add up.
Why? Sure. And remember with these funds, guys, liquidity. One of the other great benefits of these funds is you have instant liquidity.
Yep.
Especially if you buy an ETF. If you buy the fund, usually it'll settle at the end of the day, the end of the working day. But more or less, you have instant liquidity. That's a good thing. But remember, when you invest in the S&P 500 or an index fund, you really need to have a long-term investment perspective. This is not like I'm going to invest for 1 year and hope I, gain 15% and then cash out, but you need the money like in a year. That's not a smart move. You need to have at least 10, 15, 20 year, ideally, time horizon to be investing.
Yeah, these are set it and forget it. I'm just going to drop a couple more too, just depending on your preference for what company you like. If you like Schwab, they have one called the Schwab S&P 500 Index, SWPPX. And the last one, if you're really worried about fees, Sam, did you know there's one S&P fund that has an even lower fee than Vanguard? And it is 0%, like zero fees at all.
What?
Zero.
Do tell. No way.
It's the Fidelity Zero Large Cap Index. It follows the S&P 500. Same thing, top 10, all the other stocks the same. There's one catch though. If you want to buy this particular fund, you have to be a Fidelity customer. So it's kind of where they get you. But
I think that's really smart that they do that.
But most people, when they pick a brokerage, they're usually going to stick with that for life or at least multiple decades. But if you do go with that one, Fidelity Zero Cap Index, and you decide, I don't want to be with Fidelity anymore, and you want to move all your funds, you would have to sell that fund. So it's just something to keep in mind, but it is zero fees, none at all.
All right, Derek, time to put our money where our mouths are. What are you doing with the S&P 500 going forward?
I'm going to buy into some more. I think I'm going to buy a couple of these funds because I don't know. I don't like to have all my money in like one company. As great as Vanguard is, I'm like, I probably shouldn't have everything in Vanguard. I don't think Vanguard's going away. And even if they did and something happened to Vanguard, I feel like this fund would just get passed on to another company. But there's something in me that's always like something could happen. So I feel like I should spread out into like 2 or 3 of these funds. What do you think of that?
Well, I don't think there's counterparty risk there, but I understand your concern. And actually, I own two S&P 500 funds also, and I also have money separated across Vanguard and Wealthfront. So technically, I probably have 3 S&P 500 funds.
And actually, VTI might be my biggest individual holding because I hold some in my actual stock brokerage account. And I also hold some in my IRA. So I bet if I looked, VTI might actually be my biggest holding, which it doesn't make me nervous, but I'm always just like, why don't we diversify that a little bit, especially if all these funds are basically copy paste the same thing. I can give some money to someone else too.
Yeah. So take a guess why I own the S&P 500 through Vanguard's Admiral shares. It's VFIAX. It's a fund. And I also own BlackRock's S&P 500 ETF. It's BLK. Why do you think I own both of those?
One thing I want to bring up, you mentioned their Admiral shares of Vanguard. So that's a way to get your rate even lower. I think you have to have a minimum account balance or a minimum buy on those.
Yeah, it's you have to have a minimum shareholding in that fund of $3,000.
Oh, okay. So that's not bad. I thought it was higher than that, but so you save a tiny fraction of a fee, I know, on Admiral shares. I'm assuming the same thing with the BlackRock?
Yeah, so actually what I figured out was mutual funds and ETFs are very similar, but it's slightly different. And the main thing for me is if you want to buy like midday trading at a certain price, you need to buy an ETF.
ETF, yeah.
Because the fund you'll buy it at the end of the day. So sometimes you're like looking at what happens, I'm looking at the market and it's like, S&P is down 3%. I'm like, I want to buy it now. Because sometimes you wait to the end of the day and it's like recovered. I'm like, I want to buy it now.
Sometimes in the last like 15 minutes, you're like, wait, what happened? The market was just down.
Yeah.
What's up?
So you have to buy the ETF. Now, on the other side, if you want to do automated investing, like dollar cost average in an automated way, you can't do that with an ETF, or at least I haven't figured out how to do it with my ETFs. You can only do it with a fund. So I dollar cost average into the S&P 500, the Vanguard fund, every single month. I have an automatic order placed, pulls directly from my bank, like first of each month, and goes into that fund. But I can't do that with the ETF. So it goes into the VFIAX Admiral Share Fund.
I guess the only way to do it with an ETF would kind of set up limit orders and set it at like a super high price just so it hits basically like a market order.
Yeah.
And which is definitely not the most efficient way to do it. I mean, it's possible, it's a lot more work, but yeah, if you're just doing the mutual funds and you grab it at the and you say, I want $500 a month to go in this fund, and it'll just take care of it for you. It's a lot more legwork if you want to do the ETF way. And I think you're doing the right approach there. The kind of like passive, I don't want to be involved in this, or I don't want to screw it up too.
Anything else you're doing with these, Derek?
So I think the approach here is just stay on the same path. I mean, I've been doing a vast majority of my money just that I have left over into index funds. So why not just keep doing that? Because I feel like it's working. It's not as exciting as a lot of the stuff we get caught up in, but it's working. I don't know. I guess keep doing it till it doesn't work. And based on this data, it seems like it's never not going to work.
Yeah, I agree. As I continue to try to consolidate my portfolio, along with my fixed interest annuities and my physical rental property that's managed, it's really the S&P 500. I'd say those three things that kind of solidify my portfolio and give me confidence in the future, and also give me less stress than most of my other investments. And when I look at the mess I made in my Vanguard index funds, which like when we started this podcast, I'm like, I need 15 index funds,
Mm-hmm.
What's quite like comical and interesting about it is the rest of that portfolio, like 13 of those index funds pretty much emulate the S&P 500 anyways, by accident.
They all do the same thing.
Okay,
yeah.
It's like I've got a Vanguard technology fund. I've got some international funds. I got some, large cap, high yield funds. Like if you broke all that down, the overlap with just the S&P 500 is pretty, there's a lot of overlap. I have some emerging market funds and stuff that wouldn't be in the S&P 500. But, if I could go back in time, I definitely would have only chosen 3, 4, 5 funds, kept it very simple with the majority of the weight in the S&P 500. Now I'm in a position where I can't really clean up the portfolio, because if I want to sell those index funds to consolidate, I gotta realize gains. But what I am doing is I'm dollar cost averaging only into the S&P 500 every month. As I have opportunities to consolidate other indexes, I'll put more and more into the S&P 500. And as I clean up the rest of my overall investment portfolio, some of the alternative asset set investments that are coming due or falling off to the wayside, I will take any spare cash I have and lump sum into the S&P 500. But I'm willing to bet the majority of my portfolio on the S&P 500 and VGT, which is Vanguard's technology index.
Yep, I own that as
over
well.
the next 10 years. I think if we're standing here, Derek, and we're talking in the year 2034, I think for sure like those indexes will do good by then. We can't know for sure, but I would say it's a good bet to double your money by then in a very passive and easy and efficient way.
Well, the podcast will be recorded with my AI voice, and I can't guarantee that this isn't even my AI voice right now. So,
oh damn! Look forward to that. First we drop your studio, then we drop there.
I'm not needed. I'm going on vacation.
Yeah.
So now we need to hear from you, bosses. What have you found the best ways to buy into the S&P 500? I'll post all these funds right now, actually, in Patreon. So if you're a Patreon member, you got this almost 2 weeks early. And just a reminder to check out Patreon. We got lots of cool posts. Sam had a very interesting fitness post update in there. I was pretty impressed with that. I won't give it all away. But Sam, you're on quite the journey over there. I'm a little bit envious.
Dude, I'm swimming in my clothes, man. I'm walking around. These clothes are just like bags on me.
So you got that. We got tons of stuff. I just looked at we have over 400 posts on Patreon. So if you've never even signed up for Patreon, at least just give us the $5 a month to check it out. Take a look around. If you can't find $5 worth of value, there's something wrong with you. So investlikeaboss.com, click become a Patreon. Sam and I are jumping into like options. We have something this week that we might reveal on that. Mm-hmm. So you're always going to get first access inside Patreon. So check it out, investlikeaboss.com. Click become a Patreon. I need to get back to work, Sam, so I can buy some index funds.
Hey, man, that's what Warren Buffett would say. Put your money in the S&P 500 and get back to work.
Great way to go out with the Oracle of Omaha. I'm going to take Warren's advice now and get out of here. I will see you bosses next week.
Woo-hoo.
Thanks for listening to the Invest Like a Boss podcast. Join our mailing list at investlikeaboss.com to get exclusive access to our insider investment portfolios and our private members forum.
If you enjoyed this episode, please subscribe on iTunes or your favorite podcast app. Tell your friends and leave us a review in the iTunes store. It helps more than you know. See you guys next week.